Hi, folks, and welcome back to the Short Vol Show. My name is David. I just wanted to preface this video today. This is an interview with Stephen Aniston, and he's a great guy, one of my buds. This is the second interview I've done with him, so I'm going to put a little footage of background stuff from the first one real quick. But I just want to say that Stephen has some political views, and I generally don't put my own political views in my videos. That's just part of my editorial policy. So these are Stephen's ideas and his views, and they don't necessarily represent my views. But that being said, Stephen has an amazing, brilliant mind, and it's fascinating listening to him speak. So you'll notice a lot of times in this interview, I just let him speak for a while because I'm just blown away by the wealth of knowledge he has. So join me and check it out. I do have my friend Ken, who is joining me and who's going to sort of transition to helping me with the show. So bear with us as we get the quirks out and enjoy the video. Welcome to the Short Vol Show, and today I have special guest Stephen Aniston, who's come back on the show. Welcome back to the show, Stephen, after that little technical glitch.
Yeah, thank you for having me back.
Great. Well, I was looking with my friend Ken, and we looked back, and it was last December when we last talked to you. So about 6 months, maybe?
Yeah, what has happened in those 6 months? I remember you were asking about XAB back then, and unfortunately, there's no XAB now.
Yeah, and XLV no longer exists.
Yeah.
You were one of the few interviews that I did on this channel before the Volmaggedon and whatnot. And as far as I know, you and your strategy fared quite well during that period.
Yeah, that's right. We have like long and short vol strategies. The short vol strategies, they got out well ahead of the Volmaggedon. Our long strategy actually issued an alert the day before,
Oh,
believe it or
wow.
not. And actually, that strategy made it like a really nice trade to start the year. Like the long vol strategy, we hadn't heard from in something like 2 years, right? And then all of a sudden it threw up a signal then, and it was right before the Volmaggedon, you know.
Well, I remember at the time thinking and hearing you and thinking, "Wow, this guy's pretty cautious." He's talking about maybe there could be a real spike or something. And all my whole experience up till then with trading the short vol had just been like 2017 and just seeing stuff roll straight downhill, sort of.
Yeah.
And but I was in for a shock, and but it's always great to see people who were prepared for it, which you certainly were.
Yeah, it was. I mean, there were a lot of signs that were leading to it. This strategy. I mean, we've traded. I've traded vol for a few years. The short vol run didn't start in 2017. It started in 2016, and by the time we talked, that run had been going on for 2 years. And so and kind of the two best years of the strategy actually historically, because it was up something like 80% in 16, and then like 200% in 17. 150% a year is pretty spectacular. And so, but it was getting to the point where that the strategy was basically running out of gas. So it's kind of ironic. A lot of people get in right at the end to performance chase. You look back and see that you've made. People have made 3 times their money, and that's where people like to jump in, and that's usually when it's not just in short vol, that's just in any strategy, right? That's like buying gold at 2000 in 2011, right? So at some point, um, every asset class just runs out of profitability at some point, just because everybody was on the same side of the boat, you know.
Well,
And
yeah, I remember with I was looking at VMin, and I remember you and I talked about VMin, and you were uh, trying to push me away from that, saying that, well, that's really very risky. And I was looking at the returns that year. They had declared a $10 dividend. It was up like several 100%. And then you compare that to this year, where it's been stuck at $3 ever since then, and it just got crushed during
yeah,
that whole period. Now, you are known, I think, across Twitter as being having a very sharp tongue and being controversial on both sides of the political aisle, and having great stuff to say all the time. I really look forward to all your tweets that come out all the time. You do a great job with that. What do you have? Are you on one side or the other of the aisle or the other as far as politics, or how do you handle that as far as trading? Do you keep politics and trading completely separate?
no, actually, I combine politics and trading a lot, and I'm glad you asked me, because that's kind of a favorite topic of mine. There's this general aversion to not mix politics and trading, right? If you go on Seeking Alpha, they flat out reject articles that have anything with politics in it. And I think that's a big mistake. They try to focus on good companies and all that stuff, and I think that is a big mistake. If you look at how asset, in particular stocks, and how they're priced, the fundamental the fundamental valuation of a stock, right? Only about 5% of it comes from earnings, right? So everybody talks about earnings all the time, and I talk myself and I follow these things, but only about 5% of the overall valuation comes from earnings. Majority of the valuation of the stock, when you pay for a stock, you basically pay 10 times earnings or 20 times earnings. You're paying a huge multiple to earnings. And that multiple is basically confidence in that the current regime in which this company, or the S&P 500 companies, are capable of earning this money, right? And so effectively, when advisors take the test, they're basically taught about all these risks. So you have interest rate risk, you have political risk is one of them. um, Now we're talking about trade wars, whether the international trading regime is the same is a risk. So all of these things are factors into this multiple, right? And basically when multiples are very high, basically that assumes that the same regime in which earnings are being made is going to continue for a certain number of years. So for example, if you have a multiple of 20 like we have on stocks now, basically what people are saying is we're confident that the same regime of making money is going to continue for the next 20 years, and that's why we're buying stocks, right? And so to go back to the question of politics, big part of the multiple basically is the political regime, right? So for example, why did the stock market collapse in 2008? um, earnings collapsed, but also the multiple collapsed dramatically. When Obama came, it was the first time that you had basically a non-Clintonite or a non-Reaganite in the White House. It was not, his rhetoric was anti-business. So the multiple collapsed. People did not think that they were going to be able to make money during the Obama administration, right? Um, and that to an extent was true. He did have policies that inflicted secular stagnation. He did not believe in basically boosting business. He did not believe in fast recoveries that people had been used to. So he had policies to restrain these events. And we saw this with a very slow recovery over a long period of time. I mean, the economy did exactly what Obama said he wanted it to do. Now, similarly, for example, you look at Trump now, he's exactly the opposite. He wants to invoke a boom cycle. He wants to go back to what made America great, which was basically boom cycles, which unfortunately also have bust cycles after that. But on the front end of that, you have a boom, right? So to just go back to the question, politics, right? Politics results in policy, right? And then policy directly affects market prices. So, for example, if if you follow the politics, and at some point they say, hey, we're going to have a $1 trillion, let's say, tax cut, or let's say economic stimulus package. I mean, I'll just throw some general numbers out there, but basically the US GDP is about $20 trillion, right? It's like 18, 19, call it 20. The sales of the S&P 500 companies are 10 trillion, right? So if you think of it, basically every dollar of GDP that's added, about half a dollar falls to the S&P 500 companies as a revenue, right? So if they say a $1 trillion package, that means sales at the S&P 500 is going to go up 500 billion, right? Now profits are about 1/10 of that, right? So so the S&P 500 companies have $10 trillion in revenues, and they have $1 trillion in profits, right? So that means out of the 500 billion, about 50 billion is going to turn in as a profit, right? So now if you are adding a market cap, right, you have, basically you're saying earnings are going to go up by 50 billion, or on a 1 trillion, it's about 5%, right? So when they say something like, oh, we're going to do a package that's 1 trillion, right? Regardless of who it is, if it's Republicans saying via tax cuts, if it's Democrats saying via, let's say some big healthcare bill, right? Now within that, you can have things that affect various sectors, and other people are, more, specialists in that respect as to where the money ultimately goes. So I look at it kind of from a macro perspective, and does it boost the earnings, right? And also, if you have a series of these policies that boost, the GDP, then you're going to have a series of incremental earnings coming to the S&P 500, which then, boost prices, right? So to go back, politics is very important in that it affects policy, which then affects earnings, right? And the effects are not necessarily, what people think. Sometimes politics results in changes, as I said, in fiscal policy. But before Trump, we didn't have many changes in fiscal policy. Instead, for example, Democrats believe in they don't believe in usury. Basically, they believe zero interest rates would be zero. And if you look at the map of the, look at the chart of the Fed rate, I mean, the moment Obama became a president, the Fed rate went to zero before he became president and did not leave for 8 years, right? Even though on many occasions, like 2013 and 2014, the economy was very strong enough and warranted, 1% rates at minimum, even 2%. And they just didn't go off of it, partly from political pressure. The Fed is ultimately responsible to the president. He appoints the Fed chair, and also to the Senate. The Senate confirms the Fed governance board. So as you saw, when Obama left, pretty much everybody that was a Fed, on a Fed at that time, it is pretty much gone, right? I mean, you had
Bernanke.
He had, Obama picked Yellen. He picked I forget this Israeli guy. He was the second in command. All these guys. The moment Trump came to power, they resigned. I mean, they just flat out resigned. Yellen was like, "Oh, I want to stay," but she wasn't gonna get picked anyway. He's gonna put his own person in there. So anyway, to go back to it, yes, all of these things do affect the market, and affect it in a great way, and that's kind of the subject of my newsletter. And I think that's why people go to it. A lot of newsletter writers, they either have very specific political bent that they follow, or they completely avoid the topic of politics, because they can, they lose subscribers that way. People are going to attack them. You think this and you think that. I've lost subscribers because of that. People have a very hard time sometimes I get accused of being a pro-Republican, then I get accused of being pro-Democrat. I get slack from both sides depending on what I say. Because for example, when I said that the economy is going to do well under Trump, the markets are going to do well. A lot of people just they just quit and they're like, you're wrong and this and that, and they leave, right?
Oh, really?
Yeah, exactly. I mean, they think that's I'm giving a political message and I'm just this and that. And that's the reason why people avoid it. But I feel like that there is a gap. People do not give justice to political economic analysis. And I want to fill that gap. For whoever is interested in that. Yeah.
Well, I think that's I think that's great. I love the way you're able to come up. It's feeding back your my sound to you. Can you turn your speaker down a teeny bit there?
Who, me?
Yeah, because I think it's feeding back there a little bit.
Okay.
Can you still hear me a little bit? I think it's amazing your command of the numbers like that, the way you can break down the economics like that too. Well, $1 trillion, this is how it breaks down as far as the economy and everything. I've learned a lot about macro from you just watching your videos. And also, I also learned a lot about how the S&P really dominates the trading atmosphere worldwide from watching your videos. Yeah, sorry, it feeded back a little bit there. That's why I appreciate putting the earphones on for that part. So as far as politics goes, I've been the same way. Like, I try to stay away from it because I don't want to lose people, but I know it affects things. And, in a situation like yesterday where we have this political news come out, the VIX is a little bit elevated, the markets are up and the VIX is up, and you tend to think it was to do with the news that came out yesterday. Should we be taking cues from the market? Like, if the markets continues to rally, does that mean that we should have faith that, like, the government is stable in a way? Can we get clues as to what's happening in the political environment from what the market's doing at a particular moment?
Yeah, the market, increase so far has been a little bit baffling for me. I mean, I'm not going to talk about kind of what my targets are, but definitely, for example, last year we had a very bullish target on the S&P 500, and that largely came true. I mean, we basically, we called for a 20% return, which is a very strong return, and that's what we got. This year we're not, generally speaking, as bullish, but the market, has. By the way, what happened yesterday was a distinct. I think is a real problem for Trump. I tend to disregard all the Russia witch hunt and all of these things. I've largely disregarded all these things. I don't think they matter to the market. I also don't think the trade wars matter because they're just minuscule in terms of how much the actual footprint is at this point. And Trump really hasn't done anything with any thieves. But this revelation yesterday was meaningful because, his own lawyer is implicating him, and it's meaningful because this is just the first shoe to drop. There's a lot more coming. Basically, what they're doing is they're using tax evasion to get these guys to flip. So that's how they got Michael Cohen. Let's say he didn't pay $4 million in taxes or something, and then you're going to go to jail for 50 years, and then in order to get his sentence reduced to 5 years or something, then he's going to cop out to something else. So he's not the only person that they're going to do this to. So there's going to be a lot more cockroaches to come out of this, So this directly implicates the president. Ultimately, I can see them, if they go after Trump's taxes, most people that run for political office traditionally have squeaky clean tax records because they have been running for political office for a long time. So they're very careful. A person like Trump, just showed up on nowhere, and he's been cheating on his taxes forever,
Right.
just like any successful businessman does. And everybody in his surrounding circle, and they're going to go after, Al Capone went for tax evasion, right?
Right. I
So
was
so so,
thinking
so
about that when you said that.
yeah,
Yeah.
so they're going to go after that, and that is a very fruitful area for them, and it's not going to stop. Um, Now, does the market reaction, today and tomorrow determine these things? No, I mean, the market on a day-to-day moves up and down for various reasons. Um, so I wouldn't necessarily, the market is in the short term is a lot of noise. In the long run is a weighing mechanism, right? And I generally tend to look at things on a longer, kind of in a longer run, and then the way I trade is whether I'm correctly positioned on the right side of the trade, right? That's what I'm more concerned with rather than am I making money today or tomorrow or something like that.
Yeah, I've watched you sort of point out inconsistencies all the time in the way stuff sort of trades versus, that doesn't make sense. Do you, so you think is the stock market a rational place, or I guess maybe your answer would be in the long term it is, but in the short term it isn't. But is it does it make rational sense what happens in the market? Because sometimes it just seems like it's a popularity contest, and that's it.
No, the market is an extremely rational place. I don't think the moves are. I don't think the moves are random. I mean, over a period of a couple of weeks, the moves are random, but it kind of over a period of a year, the moves are very much. The moves very much make sense. And that has been without a question at any point in time. Now, the market can kind of, some the market basically the way the market works is that 50% of it is basically discount, looking at the information that's coming in now, right? Confirming what's going on right now and whether its theories about the future is correct. And about 50% of the market is discounting what's going to happen in the future, right? So the market kind of has two heads at any given point in time. Um, for example, what I try to do when I'm on Twitter, I try to basically bust myths and erroneous narratives primarily. I don't try to give people advice. That's something I do with subscribers and which side of the trade you should be on. But on Twitter, I generally try um, to bust narratives where people can get hurt following the narrative. So, for example, one of the narratives right now is, well, the market always goes in the direction of earnings, right? That's roughly correct. Most of the time it does, right? 65% of the time it does. 35% of the time it doesn't. There's many years when earnings are going up and the market is going down, and there are many years when earnings are going down and the market is going up because it's anticipating, recovery in the economy and better times ahead, or vice versa. It's anticipating a recession. Sometimes, the market goes down. Like 1987, right? You had a 25% correction out of nowhere, right? Um, the market, that was a 4 to 5% GDP year. Earnings went up like something like 25% or 40%. Um, this was an extremely good economic year in 1987, and yet the market still had a gigantic correction, right? Which bankrupted many people, right? And so the reason why that happened is, again, the market takes account of earnings, it takes account of the general political situation and so forth. But there was also another big component of it, which is interest rate, the discount rate. Um, and so when the discount rate goes up, the valuations of the market tend to go down because it's, um, basically it's easier for people to make money for free, right? So then companies have to outperform and they have to um, provide more than what the discount rate is, and that is generally difficult. The reason why the discount rate goes up, interest rate goes up, is because you have inflation, right? And an inflationary environment, um, basically the margins of the business compress. They have to pay more for input costs, for wages, well, they don't necessarily have the same pricing power to the upside, so that's why then margins compress, and that's ultimately why valuations have to compress, because uh, if you come from a place with high valuations, the valuation has to compress, even in a good economy, right? And that's what happened in '87. We had a massive devaluation in multiples, right? Which, by the way, was a great thing. It expanded this. Um, there's a problem when valuations are high, right? People do not want to invest because valuations are high. It's a big risk, right? It can contract, especially in a rising rate environment. So when the multiples contract, then you take out the risk and then people reinvest. So in 1987, the fact that this crash happened the way it happened actually elongated the business cycle for an additional 2 to 3 years at the time, right? And so, for example, what are people are calling for? So here's, for example, a scenario that could happen now. It's very similar to '87. The economy is doing well, and you have a market crash, and people are going to think that the world is going to end. Actually, a market crash right now would be the best thing to happen to the market, because the valuations right now are basically at all-time highs. Only in the '90s, for a year or two, were they higher. You have 20 to 25 PE now for 3 years running, right? And at some point, earnings are not going to grow at 25%. Like, next year, there's not going to be tax reform. Earnings are not going to grow. They're at best going to grow 10%. From the trends I'm seeing, they're not even going to grow that. They're probably going to be flat to negative. So that multiple has to contract. And actually, if it contracts severely now, actually, and valuations go down, that actually can incentivize people to put money to work. So right now, the market is in kind of a status, right? You've had some multiple contraction this year, right? So what you've seen this year is basically the market being fairly flat, flat like 5% for 6 months, right? Mm-hmm. It's not a 20% return, but earnings have gone up 25%, right? So you have the earnings skyrocketing and the market not responding to it. What's happening is multiples are contracting, and generally these multiple contraction cycles last 2 to 3 years, right? So it's not just 1 year. They usually happens. This is the first year, and then usually you have a couple more years after that.
Yeah, I wanted to ask you. You were talking a little bit before about how during the Obama years they did not allow interest rates to go higher, even though the economy was doing well. And you're in a sort of like basic economics class, you would say, like you described. In a cycle, when interest rates are low, it encourages people to invest. The economy starts to heat up. Inflation starts to go up. The economy starts to overheat, so they raise rates to kind of make money harder to borrow. It slows things down. It keeps a cap on inflation and whatnot. So now we're in the period of the cycle where we're in a rising rates environment. The economy's sort of heated up a bit, and they're in a raising rates environment. Powell's raised them a couple times. I know the president came out and said some words against raising rates. Do you think that he really feels that way, or is that just some sort of posturing by him as far as raising rates? And because for me, I feel like we should stick with the cycle of raising rates as long as we see signs of inflation and whatnot in the economy. How do you feel about the environment right now with the Fed?
So the Trump, I would probably give two reasons. I think Trump is a multi-layered person, and there's two reasons why he's doing it. The first one is kind of the typical, I'm going to stick the Fed with the blame if the market crashes, right? So he's kind of been a market cheerleader for the past year and a half, which I think is a huge political mistake. Generally the people who run against the stock market win elections, right? So he called the market big fat ugly bubble 2 years ago, and he won the election because of that. If you look at just the past 8 years, the party that was in power, Democrats used to have Congress and everything, and as the market went up, they lost everything, right? I mean, the fact that the market does well and corporate CEOs on Wall Street does well does not mean that you're going to win politically. That means exactly the opposite, actually.
Oh,
right?
wow.
So anyway, so I don't understand this tag by him, but so first of all, in the standard way, people think he's probably trying to pass the blame onto the Fed if the market tanks or the economy slows down, right? Um, so that the first thing is just the blame game, right? And the second part is, he's a real estate developer. They like low interest. Nothing kills a housing purchase like high interest rates, right? So that just kind of his business experience.
That makes sense. Yeah.
But as far as that description that you had about the cycles, now if it was about just zero interest rates, right, and keep printing money forever, right, Italy and Zimbabwe, right, would be the best economies in the world, right, and they aren't, the fact that, cheapening money and obliterating people's savings. I mean, people haven't seen America, but I come from a country, I'm originally from Bulgaria. Even though I left as a kid, my parents still live there. And, hyperinflation, obliterates people's savings. And you have a lot of old people that don't have any money. And that is a severe depression of the economy. So when you go into the mode of hyperinflation and just print money to print your way out of stuff, that does not work in the long run, right? So, um, what I want to say about the Fed, the way I got to look at the Fed is, a lot of people blame the Fed for 2000, right, or for 2007, right? Um, and I have a completely different tack on that. Um, the Fed has only one job, which is basically to stave off recession, right? And sometimes you stave off recession by lowering rate or by doing QE, right? But sometimes you stave off recession by hiking interest rates. And actually, in the late 90s, um, the Fed continued the bull run for 4 to 5 more years by keeping interest rates really high. I mean, the interest rate then was about 6%, right? And similarly, in 2004 and 2005, they prolonged the housing boom by a couple of years, by raising interest rates. Now, why is that? So you probably say, like, what I'm saying is totally the opposite of what people say on TV, right? Um, but here is how I look at it. Basically, you're right. Yes, you need to, in a recession, you need to make credit conditions easy and people need to get loans, right? But then what happens is, as the economy gets recovered, people already leverage. They've already gotten loans, right? If you couldn't buy a house, you already bought the house, right? You already bought the car. You're already locked into these payments, right? At a low rates, right? So, I mean, you can give people more credit, they won't buy more, right? Like, you need wage growth, a strong wage growth. Now, wage growth is very hard to come by, right? Because if you want, it's good in theory, I'm going to go ask my boss for a raise. The way the real world works, they don't give you a raise. You got to go and find another job that pays you more. Then they give you a raise because you found yourself another job, right? So, but generally speaking, if people, if people ask for raises, eventually they get fired, right? So increases in wages usually correspond to firing. So what happens late in the cycle in an economy, right? You basically have been in a recession for a long time. You have supply constraints. Like, for example, right now, people don't build houses. People don't drill for oil, just because we had a housing crisis just a few years ago. People are barely coming out of it. Same thing with the oil wells, right? People are barely coming out of um, a bankruptcy, when oil prices were $25, right? So there is a reluctancy now to add capacity. People are not going to build more houses. People are not going to take on more risk and build more rigs. And so you have a constraint, have capacity constraints, and then you have more demand on it, and then prices go up, right? And so in that environment, as prices go up, basically, corporations, the margins get squeezed, as I said, and then they have to start laying off people. And so basically, the only thing that the Fed can do at that time is you have higher inflation, right? You have maximum employment. Wages are hard to keep up with inflation, right? I mean, we've seen all the reports. Yes, wages are going up, but inflation is going up, so the real wages are really stagnant. And how can the Fed actually boost consumption in the aggregate, right? By raising interest rates. There's 10 trillion in savings in the US. It used to be 9 and 8, but now it's about 9.3 or something. I'll call it 10 trillion in savings. Well, if the Fed raises rates to 2%, what you end up with is an extra 200 billion, right? And so if you look at the stats this year, people were taking that money from the savings and spending it, right? So the other thing I wanted to mention is, like, people talk about the tax cut and how the tax cut really is growing the economy. That's not the reason for the strong consumption this year. This year, yes, we're adding jobs, but we're not adding more jobs than under Obama. Like the last Obama, term, we were adding jobs about 2.5 to 3 million per year. Trump is doing okay. He's adding 2.2, 2.5. I mean, it's basically the same thing.
Mm-hmm.
But so you have the jobs at the same, you're adding jobs at the same rate, but then all of a sudden you look at the consumption, and you're like, oh my God, why is the consumption so strong this year versus years past, right? What is the difference, right? I mean, if you think of it theoretically, right, the way they explain it on TV, rates were lower before. You had a lot of more job. Consumption should have been stronger before.
It should have been stronger before, yeah.
But it isn't, right? It's actually stronger. Now, the reason why it's stronger is because before, people didn't make any money from savings, and they did not spend that money from savings. They still have the savings. The savings never gone down, but now this year they have an extra 200 billion in aggregate, and this tax cut, was actually a tax hike on individuals, right? They removed a lot of deductions, the sole deduction, the personal exemption, which is a huge one. Actually, if you look at the individual income tax collections this year, they went up by about $100 billion. Last year they were 1.3 trillion in collections, year to date. This year they're 1.4. So corporation taxes went down, but individual taxes went up, right? So how do you take out $100 billion in income from consumers, and then you still have strong consumption data, right? So what's actually happening is the people got an extra $200 billion from savings, which basically offset the tax cuts, tax on another $100 billion, and also at the same time we have a similar dynamic happening right in 2007, where people were increasing their borrowing, so they're putting on more on a credit card, and so you have extra savings, and people borrow more because they have more savings too, right? On aggregate. So you have higher borrowing and higher savings offsetting the tax hikes that people got. So that's the true reason for the consumption boom this year, which is, like, I think it's completely misrepresented in the media, the reasons for it.
Yeah, it's like, in a sense, when interest rates go up, people only think of the side of someone having to pay more rates. They're not thinking of the side of the person that's actually receiving that money from higher rates and reinvesting that or spending it. Yeah,
that's right. I mean, it is true that most of that money goes to kind of the more well-off members of society, but then these people are spending more, right? And so what I'm trying to say is, like, the Fed prolongs cycles by hiking rates, right? So in the 90s, you had 6% rate, 6% rates. People were getting a massive amount of money, which they reinvested in, some of it they invested in the market, and they kept paying top dollar for stocks. Why? Because they had the money, they had the free money coming in, right? The same thing in 2005 and 2006, because basically what happens is, if you have a certain salary, right, and it doesn't grow, you cannot, once things spike past a certain price, you cannot afford it, right? And so it is inflation that kills people say, oh, the Fed kills the economic cycle. No, it's inflation that kills the economic cycle, right? And basically what the Fed does right now is inflation, it's at 10-year highs right now, right? People say, oh, there's no inflation. Well, compared with the last 10 years, it's the highest inflation we've had, right? Yes, it's not 80s level inflation or anything like that, but for where we are right now, this is the highest inflation we've seen in a long time. And so with the Fed raising rates, they actually are extending. So Trump, he has been very, he has to be praising Powell for, helping him boost the economy, as opposed to But basically, he's married to that whole credit thing. The thinking of credit, right? Credit is the only way to boost an economy. That's not true. You can boost the economy through savings. Actually, the strongest economic boost is from savings. If you can take the savings that you have and reinvest them into a business, that's also a way to grow an economy.
All right, I want to ask you for those who did not see our first interview. I was wondering if you could just break down for me a little bit what sort of services you offer, and also, so if somebody was to come to you and say, Steven, I have I have a good salary. I make a lot of money. I want to be responsible with how I plan for my family's future, and how can you help me with that? How do you help people specifically? Do you have a very specific fund that you tell them to go to? Do you just give them general ideas of how to invest and philosophy, or do you give them specific investments? How do you work with the people that get your newsletter?
So the
And what's it about? I guess I just want you to sort of break down some of the things that you have to offer for people who maybe have seen you for the first time right here, right now.
Yeah. So my website is started out, it's called vixcontango.com, and it started out as basically a set of reports that will help people to trade volatility, right? Which is a very kind of high risk, high return asset class, right? And then I have been kind of expanding my offerings. So I also have a lot of opinion about macro topics. I marry politics and stock markets, and I kind of just give a holistic view both from a technical and from fundamental side. So I have a newsletter which I send out every day and every weekend, in which I keep people appraised of the current progress in the market and what's the reason where the market is going. I also give my view of where things are going to go and where certain asset classes are going to go. In addition, so this is basically, if you have kind of a portfolio, you get a good idea. Should I be in bonds? Should I be in stocks? Are there any danger signs? Our website has a kind of a green and yellow coloring scheme that basically would tell us where the market is in trouble, where the market is okay. And in addition to that, I have a couple algorithms that help people with volatility trading, when to get in and when to get out. They're geared towards, swing traders. They're not for day traders or anything like that. And I have a couple of I also I've added a couple of site services over the past year, which are, whenever there's something happening in the crypto space, I give people ideas about where to get in or where to get out of various crypto investments that I understand. I don't cover all, I cover only what I understand. I also give people, I have a technology background, so some of these stocks that the market really likes right now are, cloud stocks or stocks related to the cloud or to technology companies that are high growers, right? That they're, maybe a recent IPO or has a very attractive valuation and you can get it in. So I give people tips about that. So for example, if you if you invest in both things, you kind of you can kind of, let's say you're long volatility and you're long some of these stocks. If the long volatility doesn't work out, these stocks are making money because it's a bull market, right? So you kind of net you're flat, right? And those things are expected to outperform the market significantly. So and then I give people, as I said, like some recommendation about various ETFs when I see good opportunities. It's been very hard to get opportunities now, but in the past, I've had good, for example, buying energy, before oil prices would go up or something like that, buying the XLE, general sectors.
Do you? So we were talking a little bit about Trump having sort of more of a philosophy of a boom and a bust cycle. Do you actively like try to figure out where the top of the market is? Do you think about that a lot? I know a lot of people are sort of preoccupied with, when's this market going to be over? When's there going to be the next correction? Do you have any sort of thoughts on that?
Yeah, I don't look at, even though there are big cycles, right? And, the market does move in big, gigantic cycles. I don't particularly spend a long time whether January was the top or whether right now is the top. A lot of times before market collapses, they want to suck in as many people as possible. And the way they suck it in is they basically break out to new highs, right? And stay there for a while. And then everybody believes that we're headed higher because we've had a higher high, and then the market starts to drop, and then usually people pile in after that, thinking that we're going to go to another higher high, and then and that's where usually people lose the most amount of money. Is in that space where they buy the dip after a high, and they keep buying the dip, and the thing just continues to drop. That's where people make the biggest mistakes, right? So the way I doesn't doesn't mean I would be immune of that or anything like that, but I don't spend my time um, figuring out the ultimate market top, right? Basically, what I try to figure out is try to get intelligence, from the hedging markets, and see, I look at a number of indicators, but I take the hedging markets very seriously because this is a very expensive market class, and if it's sending me a different signal, I treat the signal very seriously, and it is more or less felt not on a day-to-day basis, right? Whether the VIX goes up or down, and how it's going to bounce over a period of a year, 6 months to a year, right? So for example, so that then tells me whether these gains are that the market is making are permanent, whether you can really participate in the market. So for example, I'll give you an example. Um, one thing you can look at is the average VIX, right? You can look at the average VIX for the year and how it changed over the prior year. So for example, if you looked at from 2006 to 2007, in 2007 you had a positive return, right? I mean, the market has been positive for what is it, for like 15 straight years now. It hasn't had a down year since like 2003 or something like that. 2008, sorry. But if you go back to 2003, it's like one down year and like 15 positive, right? It's kind of been an insane run. But basically, the way you could tell that there would be a big correction, right? Like in 2011, there was a big correction. In 2015 was a big correction. What happened is the VIX on average rose from the prior year. So in 2006, the VIX was, let's say, 12, and in 2007, the VIX was 17. I mean, that told you that even though the market reached a higher high, in October, these weren't gains that you could keep. There was very likely to be a massive correction, which in this case turned into a bear market. Now, in 2011, the same thing happened. In 2010, the VIX was 22, and then in 2011 it was about 24. That told you that you're going to get a big correction. And you got almost a bear market, right? The same thing happened in 2015. In 2014, the VIX was like 12, and then it went to 15. It rose. The average VIX rose. And that told you that you're going to have a correction. Now, for example, in 2016, a lot of people were bearish, right? The market was down. It had made a lower high. It had made a lower low as well, right? In February. So a lot of people then were like, "Oh my God, this is the wheels are falling off this thing," right? But what happened in hedging markets then? The VIX actually declined from 2015 to 2016 on average. The VIX generally declined. So that to me told me, okay, now we're going to have a bump, and this actually is going to continue going higher, right? The hedging market told me, what's so. For example, this year, why I'm, even though the market is going up, I mean, I'm generally a volatility advisor. I do my, right now this year, obviously SVXY, XAV is blown up. SVXY, has done, okay since the ball, but SVXY is down on the year dramatically. And since there has been basically, okay, maybe it's up like 20-30% or something, but it is not the scintillating pace that it was. And you have a few games for a couple weeks, and then they all get rolled back overnight, right?
Yeah.
All of your games. So basically the contango and the roll yield, the spreads in a volatility space have just evaporated. There used to be, the difference between the VIX and the second contract would average about 15. Last year was 20%, 10%. These are the huge cost to pay to hold VIX. This year, that cost has dropped to something like, I don't know, 4%, 2%. Basically, you don't get paid to be short the VIX. Or we can look at it another way. You're not losing money being long. You're not losing money taking an opposite position to the market. You can just hang in it, and wait for the market to crash, right? And actually, what can happen if the market continues to escalate higher, right? It is what happened in 2008 when this is a phenomenon that was observed in the late 90s. So for example, the market is super expensive right now. Everybody knows this valuation is crazy, and they don't, they know at some point it's going to end, right? But like you said, markets tend to people call it euphoria. I call it markets tend to predict something that tend to predict higher earnings. For example, if earnings were to skyrocket, right, you're going to have multiple expansion, and the market is going to get even more expensive. That's what happened in the late 90s. You had, like, people were going gaga right now over 25% growth, which was mostly tax policy, right? In the late 90s, you had year after year, you had 40% earnings growth. You don't understand, like, from 96 to 97, from 97 to 98, earnings would grow up 40 to 50%. That's why the valuations were very high then, because you had high growth. The same reason why Facebook has a high valuation is because, they grow earnings 50% a year. At that point, practically any valuation is acceptable, right? So there's very good reasons for the market to trade at high valuations. So what happens then is people always kind of look over the shoulder. This is not sustainable. How long is this gonna last, right? Then they start to hedge. So what they do is they're forced to be in the market. They're forced to chase it, and then what happens is they start to augment their chasing with calls, because basically it's a synthetic long position that doesn't cost you much. So what people started is they started to buy calls. Then the VIX goes up because of call buying. So that's what happened in January, right? At some point, what happens is the hedging markets, right? They tend to go up together with the markets themselves, with the S&P 500.
So we saw that in January. Definitely, we saw that a lot. Yeah.
Well, we've seen it all year, right? I mean, the VIX last year averaged 11. This year is averaging 15. Right. So on average, the VIX is, the VIX-X is basically slightly positive, but just on any slight disturbance, the VIX goes up 10% on the year, which is beating the S&P 500, right? The VX-X was basically 20 to 30% all year, ahead of it. And, only basically a streak of uninterrupted positive months is keeping it to being flat, you have any down month, and then the VIX is gonna, the VX-X is gonna run ahead of the S&P 500 quite dramatically. So you have a situation here where actually the hedging markets are outperforming, the S&P 500 itself, and historically that has led to weaker performance, to corrections or bear markets.
Yeah, that's bizarre.
Yeah, so that's why I keep when I a lot of people trade the past, so there's a lot of there's a lot of people want to trade the 300% gain in the XAV, right? And it's just the fundamental conditions are not there. You got that 300% gain because month in and month out, you have 15% contango roll, right? You don't have that now. I mean, how are you going to get that 300%? You don't have 15% contango roll, and the VIX is already at 12. I mean, it's not going to go to like zero, right? So that's kind of there's no money in that trade. By the way, there's not a whole lot of money alongside, but at least you're not losing money like crazy.
So yeah, I mean, I found focusing on the VIX, kind of like your website focus on the VIX. During these times, I've looked to other strategies, and it sounds like you have a little bit as well to augment things because, like you said, it's gotten so cheap at times, the volatility, that it's almost worth it just being long it because it doesn't cost that much to be long it. There's not that much drag, like you said, so it's almost worth it. Like it's like you have a free call, being long it.
You have a free call, exactly. Yeah.
And people did great obviously in February being long volatility, but so do you see it continuing staying like relatively flat as far as contango, or do you see things going kind of back to normal? Because it kind of sounds like your idea is that the valuations are so high right now that things can't really get back on to just a continuation of the rally, and thus contango steepening up again.
Yeah, I mean, generally speaking, my call for this year was that volatility is going to normalize, right? So last year the average VIX was 11. And my call this year was the average VIX will be like something 14, 15 or something like that.
Yeah.
Which is exactly what happened. So volatility is going to normalize, and we have seen normal volatility this year, right? So for next year, I mean, I haven't made my calls for next year, but generally when volatility starts to rise, it tends to, we're coming off very low levels, and that's not something that kind of like turns around and reverses on a dime, right? So the trend is in the other, is to go up through next year, so what will be fundamental drivers for higher volatility in the future? And so now, see, I'm gonna get in trouble now again with a political statement, but if the Democrats win the House, so everybody's pretending as if like politics don't matter. Politics matter what to markets, the reason why the market just skyrocketed after 2008 is because the Republicans won the House and stopped the spending of the Democrats, right? That's why the market skyrocketed. The House went in 2010, and then the Republicans browbeating Obama into extending the Bush tax cuts, right? All these things were the reason why the market went up. If these things didn't happen, we would have had a different market outcome, right? So right now the market is pretending as if the elections don't matter, right? And I have to, like I said before, the market kind of looks at the past and also looks at the future, right? And because of the fact that the market also looks at the past, half of the market is looking at the past, the market is continuously wrong about developments in the world. Now, if people say, "Oh, the market knows all," the market does not all, right? It is offsides a lot. It was offside with regards to Trump. It was offside with regards to Brexit, right? People were positioned very negatively in 2016. As a general rule, and then we got to bounce higher. People, the market does get it wrong a lot of time. And for example, in this case, the market is basically saying that the Democrats are going to win the House, or is ignoring the fact that Democrats are going to win the House, because basically they're saying, "Oh, we know these polls, they're saying the Democrats are going to win, and we know that the polls were wrong under Trump, right? And they were wrong under Brexit, and therefore, who knows? Probably the Republicans are going to win, right? Because the Trump voter is going to show up." Well, to that, my retort is, well, Trump is not on the ballot, right? I mean, what you have on the ballot is, your standard Republican, which people hate. I mean, Trump beat those guys in 2016. Why do you think these guys are going to win, right? Trump is not on the ballot. Trump kicked out Bannon. He kicked out the Bannon voter, right? He's largely been a sellout for, I mean, people talk about tariffs. All this stuff is really non-consequential. We haven't systematically addressed the issue with China. You would have passed a border adjusted tax. If Trump was really wanted to drill into China, he would have thrown his support behind the border adjusted tax, which would have systematically imposed basically a tariff on foreign products. And he would have dealt it that way. He didn't. He was actively campaigning against the border adjusted tax, which Bannon was for. So he hasn't quite lived up to the expectations of the Bannon voter. Maybe he has on immigration and stuff like that, but really he hasn't economically on economic nationalism, and that's a problem. So for example, if that voter doesn't show up, I don't think the Republicans are going to keep the House, right? So then you're going to have Democrats. Now a lot of people who are liberals, oh great, we have Democrats, we're going to stop Trump, right? So they feel positive about that. They'll buy stocks because of that, right? My look at it is basically, if they win the House, together, Trump is definitely on an Nixonian path of impeachment. He's going to be a very weak president under them, and there's two scenarios: either remove him, or they basically blackmail him, right? So basically, if he wants to stay in office, he has to accede to their agenda, which will be rolling back the corporate tax cuts. So if you roll back the corporate tax cuts, then a lot of the sugar, the market is basically trading on these corporate tax cuts staying forever. I don't think they can stay forever because deficits are expanding. So the market has an issue here. You cannot run this game where Trump also expanded spend. Actually, tax collections are higher, right? Because of individuals are taxed higher, but individuals can't just carry all the tax burden, right? And at the same time, they increase spending. That's why the deficit is higher, because of the increased spending, even though tax collections are. But at some point, corporations are going to have to, they're going to have to go after them. And corporations also haven't repatriated about 200, S&P 500. They haven't repatriated about $250 billion. Everybody's mum about that, but they're like, it's as if this money disappeared, like they were supposed to bring him in. Then the Treasury issued that edict where it says oh, you can have 1 year. So now all the banks are figuring out how to basically hide the money again. They were given 1 year to figure out another way to hide it, right? And so all the corporations just kind of on a magic switch, they stop reporting their repatriations. And I think one way or another they have to do it, or basically the administration postpones it again. I'm not sure. I'm not sure what's exactly going to happen, but the reason why the market is up right now is basically because they think that this money does not have to be repatriated, because it's $250 billion. It's a substantial amount of money, right? That reduces earnings by $15 to $20 if they have to repatriate gap earnings. So I think the market is up because they think that basically they're going to be able to get away with not paying tax on this money.
And so basically, if the Democrats do get the House, then reality is going to set in and things are going to start to change. Either there's going to be more pressure to repatriate the money.
Yeah, so if the House wins, and depending on how these things play out, I can't kind of configure everything else, but right. if tax rates rise, that'll compress margins and that will kill the multiple, right? So that's one way. So if you have inflation trying to kill the multiple, then potentially you can have fiscal policy killing the multiple, right? If Democrats get in, so that's something that the market does not seem to be factoring right now.
Yeah. Yeah, it doesn't seem to be phased by anything right now, actually.
Now, on the obverse, again, I have to say, if Republicans do retain the House, right? The Senate is kind of almost a shoo-in for Republicans, right? It's a very hard math. They're gonna expand their majority in the Senate, right? So if the Republicans do maintain the House, you're very likely to get another tax cut. By the way, they have a reconciliation procedure and opens up again. So reconciliation procedure where they can basically blow up the deficit by $1 trillion is available every Congress. So they did that for their tax cut before. But if they win again, that becomes available again in the beginning of 2019. So they can again stimulate the economy with another $1 trillion, right? So that's what I'm saying. Like it's kind of the election doesn't matter. Like you have to think with the way the market is saying, there's a 50-50 chance that you're going to have a super bullish scenario of GOP winning, and a somewhat bearish scenario of Democrats winning, and basically we're going to trade it right in the middle, right? That's how I interpret the price action now. But you know,
we'll have to wait and see to some extent.
You know, I think the polls, you know, the polls were wrong about Trump and they were wrong about Brexit. I don't think the polls are generally wrong. They've gotten most elections in the past correctly. We do not have a populist election right now. The populism on the side of the Democrats, you know, the Democratic Socialists are running with populism right now. So that actually tips the scales for it. Most professional political models assign about a 73, you know, call it 75% chance for Democrats winning. So the market really has to be discounting 70% chance. It doesn't seem to be doing that right now.
Yeah. And then I don't know. The other question I have in my mind is like, well, you know, what would happen if the Democrats win and they impeach the president? It's not necessarily the end of the market, correct? I mean, the market could still kind of sort of survive that scenario, or what do you think about that scenario? I don't think it's very likely to happen, but
well, no. I mean, we you know, Nixon got impeached, and Nixon was, you know, when he got elected for the second term. I mean, he had like something like 520 or something like that, 500 electoral. I mean, basically the entire country voted for him. You know, he was, you know, his position in the Republican Party was like, you know, Nixon is, you know, the father of the modern, you know, neoconservative Republican Party, right? Even more so than Reagan, you know, to a lot of people. And so he was an extremely strong figure, you know. That's why he overreached with Watergate, because he was so he thought he could get away with anything. That's how strong he was, and ultimately, when that thing went, I mean, the market went just down for 2 straight years. You know, like the Watergate kind of started about in the summer of '72 is when Bob Woodward came out. This stuff, people started coming out this and that in the start of '73. The vice president resigned supposedly over unrelated charges of bribery, right? About a year before Nixon. Nixon resigned in August of '74. I mean, the market was basically straight down for 2 years. You know, lost like 50% straight down for 2 years, and people kind of blame, oh, it was, you know, Bretton Woods and this and that, and the macro environment and high inflation. You know, that's true, but you know, the same, very similar things are happening now. I mean, Trump wants to disturb the global setup of the global order, you know, the global trading order. He wants to, you know, we do have stronger inflation. I mean, you know, a lot of people also on TV talk about inflation going to go down. The indicator I look at suggests we're going to go to 3 to 4% inflation next year. I mean, I was completely out of consensus. You know, in the beginning of the year, I said we're going to have 2.7% inflation. We're going to have 2.2% GDP growth, right? And everybody on TV was saying, like, you know, same like last year, you know, 1% inflation and 2% GDP growth. Everybody was wrong, like you wouldn't believe. You know, we got strong inflation and we got strong GDP growth. You know, so this is not this inflation. You just dump in 4 trillion of stimulus. You know, 3 trillion of stimulus. You know, through tax cuts, through military spending, through you know, even welfare spending, if you will. You know, that all that stuff increased under Trump. So
it's got to cause inflation somewhere. Yeah,
it's on a market it's already, you know, job market it's already full. I mean, it's causing inflation. You know, there's no other way, and these trends are only going to continue. I mean, there's indicators there that predict inflation. They are pointing right now to 3.5% inflation over the next 6 months. So people are not prepared for that. Or in the market multiple is not prepared for that, for 3.5% inflation.
So do you recommend, if people are really worried about the midterm elections, do you recommend that they try to kind of go to cash of some of their portfolio, or like kind of go risk off during that period, or how do you play
uh,
that sort of situation?
in the S&P 500, I mean, I've basically been cash for since like October of last year. I mean, I've missed like 10% of gains or something like that. I could have bought the dip in the middle of the year. I didn't. Um, I don't really care about like 10% gains, or 15 or 20. I don't really care about that much. That's basically, the S&P 500 has a 15% annualized volatility. You're gonna get a 15% dip from which to make 10 to 15% at any point. And even if you don't, you're gonna get it eventually. So that doesn't concern me. Um, part of the reason is I bought the dip in 2006, so I was outperforming the market significantly by the time it ramped up. So even though the market was up like 5-6%, I was up like 15, right? So I've already made the 10% that we're seeing now, right? So I don't care about that. So I've generally been out of stocks, except for, as I said, some of these secular growers, secular stars, tech stocks that are cheap market cap but grow, revenues 50% a year. That seems to work. People go to that.
That's
So
interesting.
so so yeah. I mean, right now I'm basically, I'm out of the market. I have my money in treasuries, and every 3 months I get a pay raise because, if they're 2% now, they're gonna be 2.5%. I mean, okay, so the market's gonna make 6%. I mean, I already make 3%, right? It's basically the same thing. Uh, I'm not in the market right now to begin with. So in terms of the election, as I said, like if GOP wins, you're probably gonna have a big rally. Um, at that point, if the hedging markets, go in a direction that confirms the rally, then I'll participate. Right now, the hedging markets are not going in the direction of the market, or pardon me, they're going together with the market up, which is not a confirmation, right? It's not a confirmation of the market upside. So I don't really think that people should be in the market at all.
I really admire your ability to be able to kind of step back from the situation and see it from sort of a farther away perspective than most people are. They're into the earnings cycle right now, and they're just looking at a couple stocks day to day, and they're caught up in that grind. You seem to be able to kind of back up from the situation and take a longer term view of it, and kind of strategize over a much longer term. And I think that's a great different perspective for people to have. There's so many people are in the StockTwits and they're just watching one or two stocks and just churning and not really paying attention to the macroeconomics for one thing, and just sort of the main macro picture. And I've always gotten a lot out of listening to what you have to say about these issues. I know that you've talked a lot also about that repatriation of money issue in your newsletter as well over time, and that's a big piece in the puzzle here. So how do people? I want to give people a chance to get your newsletter if they like to. How would they go about doing that?
So they would go to my website vixcontango.com, and they can sign up there. It's about $100 a month. It's not cheap, but I need to kind of run the website. But again, our like you described, our view is kind of a little bit more detached, a little bit more macro, and whoever has been with us has been able to make a lot of money over the last couple of years. A lot of people come in and they kind of expect quick results. And sometimes when I take these positions, they basically it's kind of at the end of the cycle, it's in front of a turn. Sometimes there's kind of there's a period of either flat or losses for a while, before the boat is being held underwater, and the markets can do that for a very long time. And but the important thing is to be, so a lot of people are impatient. A lot of people like quit right before, like for example in 2016, I was kind of long vol for about for kind of all of 15, and then the thing happened, the crash happened. And then I was a little bit long vol, but then I turned, right? So I was kind of long vol for a year, and then I turned to short vol in 16, and kind of at the bottom there around February, March. And then like a lot of people left. They're like, the market's going down, you're wrong, right? And then they left, and they just weren't able to wait for 2 3 months. The short vol was like down 20-30% or something like that. Which for the trade, that it can recover in 2 days, right? So, but people kind of look at these things. They either can't handle the higher nature of the volatility of that trade, or they get out. Then it runs. We make like 200 to 300% over the next like year, and then people are back. People were back, and they're like, okay, I want to make more of that. And then I'm like, well, but we've missed
Right.
about a year of the run. It's like it can't go on forever, right? So some of these things require patience. That's the way I look at it. You just gotta be kind of, you gotta take a look at on which side is the asymmetrical return, right? On which side is the big gain, right? The future gain, right? And then that's what you gotta, not the past.
So it's like, so you're in the business of when we get that sell off, buying the dip at some point. That's what you're looking to do when multiples are lower.
Yeah, so people tend to stick with us. All of the people that have been with us like 2-3 years, they're still with us because they've made a lot of money. So this year, it was good in the beginning. It's been kind of tough the last 2-3 months being long, but all right.
Mm-hmm.
But basically a flat year, compared to like 100% last year, right? Or 300%. Some people made a lot of money last year. My subscribers tend to make more money than me, right? So they.
Well, the other thing is you avoided the Volmaggedon, which is a huge thing. I mean, most people that trade
avoiding that,
exactly,
keeping the money,
yeah, that's the biggest thing of all, because most people that are trading volatility got smacked around huge in February, and avoiding the smackdowns, all that's left behind is the profits, So
yeah, no, I to be honest, even myself was kind of shocked at the way this thing developed. I mean, I was expecting kind of some kind of spike, but I hardly imagined that they're going to do it overnight. It was pretty. I thought I was kind of. I think the product was broke. I think that was kind of mishandled by the industry. But we were due for an event like that. I mean, we're definitely due for an event like that.
Yeah, and that was an amazing moment in time. It happened really quickly, like you said. It blew out, XIV and all these other funds changed their leverage. But it'll come back around again, and people will over leverage again someday. But yeah, that was an amazing thing. Well, listen, I really appreciate you coming on and talking for such a sort of an extended period this time. I start listening to you talk about macroeconomics, and I can go on forever, because it's very interesting to see how your mind works and to hear you break down the numbers in such a articulate way when you talk about these things. So thank you so much for sharing a little of your time with us today, and hopefully we can check in with you maybe after the midterms and see what you're thinking about then. In the meantime, please, everybody, check out vixcontango.com. And we all know that, one decent trade pays for the newsletter for a year.
That's right.
Or avoiding the Volmaggedon is going to be worth a lot more than $1,200 to many people out there, which is what you did. So thanks for doing the show, and great to talk to you again, Steven.
Thank you for having me.
Okay.
Good to see you again.
And thanks, everybody, and we'll see you next time on the Short Vol Show. And thanks to Ken here. Thanks to Ken. Wave, Ken.
Thank you.
All right, great. Thanks, buddy. All right, so I'm going to turn it off. This is Dave and Ken signing off. We'll see you next time.